What's going on, guys? So in today's video, we're going to be talking about 12 different stocks that will pay you guys £1,000 per month in dividend income. And I'll be answering what the magic number is that you need invested in each one of these stocks in order to be able to achieve this. But before I do so, guys, I just want to say a massive thank you for 5,000 subscribers. It seems pretty insane that 5,000 people have come onto my channel, watched the video and liked the video and ended up being a subscriber of the channel itself. And it's extremely humbling that you guys are actually enjoying the content on the channel. So for that reason, I just want to say I'm genuinely grateful for all of the support that you guys give me. But with that being said, if you are new around here, my name's Mitch. I post all kinds of videos on investing in the stock market. If you do enjoy content like that, hit that big red subscribe button down below as well. Drop a thumbs up on the video, guys. It really does help out the channel. With that being said, let's dive straight into it. So in this video, we're going to be focusing primarily on Dividend Aristocrats for all of you dividend investors out there, minus one of those companies, just to provide additional perspective. Now, for those of you guys who don't know, a Dividend Aristocrat is a constituent of the S&P 500 index who has consecutively increased their dividend payouts for 25 years or more. So you can be pretty certain that these companies will not want to lose that Dividend Aristocrat status, and because of that, you could probably assume that your £1,000 per month in dividends is a pretty safe bet. But if you are ever unsure of the safety of a dividend being paid out by a company, there are a few key metrics in which you can check out. So let me just take Walmart as a prime example, a company who are considered to have a safe dividend safety score, scoring 78 out of 100. Now, with 100 being the best and 0 being the worst, 78 seems like a pretty safe score as a whole to assume that Walmart will be continuing to pay their dividends for the foreseeable future. So let's take a look at some of the metrics. The first one being the payout ratio. This is a percentage of the company's profits in which they pay out to shareholders via a dividend. Now, for Walmart, their payout ratio currently sits at 41%, which is a good position to be in because they still have scope to increase that dividend over time. The next key metric to look at is net debt to earnings before interest, tax, depreciation, and amortization. Now, for all of you non-accountants out there like me, essentially all this means is it's a comparison between the company's debt in which they have on the books versus that of the company's earnings. Now, debt isn't always a bad thing, but if you do see companies who have an extremely high score when we're looking at debt to earnings, this could indicate that a company are highly leveraged and potentially at risk of potential default on some of the debt in which they have. So because of that, that could have a knock-on effect on the dividend safety score in which a company has too. The next key metric to look at is the company's dividend streak. Now, for Walmart, they have consecutively increased their dividends for 47 years, which is obviously a pretty phenomenal statistic for all of you dividend investors out there. The final metric to look at is the recession returns / the recession sales in which the company has. It's always a good metric to look at because it does tend to highlight how recession-proof a company is. The reason being, as we've seen this year, we've had slightly unique market conditions and we have had some previously reliable companies that do certainly pay dividends like Walt Disney, all of a sudden begin to cut their dividend in order to keep some more money on the books. So when you are looking at dividend investing, I would highly recommend that you do tend to look at these 4 or 5 different metrics just to get you started. So now we've spoken about that, now let me talk to you guys about the 12 companies that I'm going to be featuring within this video to pay you that sweet dividend income. So first up on the list, we have Apple, who are obviously a huge tech company, year-to-date returns offering 55.28%. Then we've got AbbVie, a biopharmaceutical company with a year-to-date return of negative 7.46%. Then we've got Caterpillar, who are a construction and machinery company, year-to-date returns of 4.9%. We've got Chevron, who are an oil company, year-to-date returns of negative 42.76%. Johnson & Johnson, a medical and consumer goods company, year-to-date returns negative 1.93%. Coca-Cola, who are a beverage company, year-to-date returns of negative 9.44%. McDonald's, a fast food company, who are year-to-date returns of 11%. We've got 3M, who are a multinational conglomerate with year-to-date returns of negative 10.5%. Then we've got Procter & Gamble, who are a consumer goods company, year-to-date returns of 15.3%. We've then got PepsiCo, who are a food and drinks company, year-to-date returns of 2.4%. AT&T, who are a massive telecoms company, year-to-date returns of minus 30.7%. And final up on the list, we have Walmart, who are a retail / food company with year-to-date returns of just over 20%. So we certainly have a mixed bag of pretty fantastic companies on the list today, but not all of those companies are fantastic when it comes to looking at their stock returns. And that's why when I hear people say, oh, I'm just a dividend investor, I'm just looking for those dividend yields and that dividend income, it certainly does raise some concerns because by being a dividend investor, you could possibly lose sight of the overall stock performance of the company if you're just solely focused on the dividend. To put this into context for you guys, your 8% dividend yield on AT&T stock might feel quite good in terms of the income that it provides you, but if the value of your investment portfolio drops off the best part of 30% during the year, you're probably not going to feel all that good about that dividend yield anymore. So that's why it's important not just to solely focus on a company's dividend yield, but also still have the wider macro picture of the overall performance of the company in mind too. So hopefully I've prefaced that well enough. So now let's dive in to those 12 different stocks that are going to pay you guys £1,000 per month and how much you guys need invested in order to be able to achieve that. So bringing up the little tracker in which I've created for you guys, there are a couple of key things that I do need to call out prior to explaining all of this to you. The first thing to call out is that I have not checked whether each one of these individual companies actually pays out dividends on consecutive calendar months of the year. However, what you will probably know is the fact that we've got 12 different stocks which will pay you £1,000 on average per year, because some of them will be quarterly payments, some of them will be biannual payments. On the whole, as an average, it will add up to £1,000 per month. The next thing that you guys are probably taking notice of is the fact that all of these stocks down the left-hand side are obviously American stocks, most of them probably listed on the New York Stock Exchange. However, I've labeled their current market price in pounds. I've actually done a currency conversion, as you guys can see from the formula at the top of the screen, from US dollars back to Great British pounds. So we have this from the perspective of what you would actually need from a pound sterling perspective for all of you UK investors out there. The next thing to observe is the dividend per share amount and the dividend yields are actually slightly different to those in which you've probably seen online. The reason why these numbers differ is because if you're over here in the UK and if you're investing into a US company, you do pay a 15% tax on dividends, which is automatically deducted from your dividend amount in which you receive from your broker. And that's where you can see at the formula at the top where I've done the currency conversion and then I've done the multiplier by 0.85 to give us that 15% less. So with all of that out of the way, we can now look at the consecutive annual dividend increases. You can see all of these stocks, bar Apple, have pretty much consecutively increased their dividends decade after decade after decade, with the likes of 3M as well as Procter & Gamble increasing their dividends for 60 plus consecutive years. Then similarly in column G, we have the dividend safety scores of all of these individual companies, and I will leave a link to the website down in the description below for you guys to check out the dividend safety scores of the companies in which you have within your portfolio too. So now let's move into column I and talk about the dividend income on an annual basis. So obviously the aim of the game is to have £1,000 per month, £12,000 per year, or essentially £1,000 for each one of these 12 stocks in which we have. So to give you guys some perspective, we've started off with Apple. £1,000 per year in income from Apple would require you to have 465 shares at a cost basis of just over £40,000. And to provide some additional context, because the current market prices as well as the dividend yields per company differ, the number of shares that are required to achieve that £1,000 do differ per company in which you want to invest into. So as you guys can see, probably the lower end of the spectrum is probably Chevron at 296 shares that you need to acquire, whereas on Coca-Cola, on the other hand, you need over 900 shares to be able to still receive that £1,000 in income. So now let's have a look at the cost basis to see how much this is actually going to cost us to be able to achieve that £12,000 per year in annual income or £1,000 per month. So for Apple, it's just over 40 grand. For AbbVie, it's going to cost you just over £20,000. When we drop it down to Caterpillar, that's going to cost you £43,000. Then for Chevron, it's going to cost you only £15,000. Johnson & Johnson is going to cost you over 40 grand. For Coca-Cola, it's going to cost you £34,500. For McDonald's, it's going to cost you £49,000. For 3M, it's going to cost you just under £32,000. Then for Procter & Gamble, it's going to cost you just over £51,000. For PepsiCo, 38.5 grand. Then we've got AT&T, 15 grand. And then we've got Walmart, finally costing you £76,000. So as a total cost basis, in order to achieve that £12,000 in annual income, it's going to cost you £456,840. And you can see how this looks visually on the chart in terms of what you need in value within that portfolio invested into that specific stock in order to be able to achieve that £1,000 in dividend income. Now, that may certainly feel like a lot of money to have invested into the market, and it may even feel a little bit unachievable. However, do bear in mind there are a couple of key factors that you're going to need to know about, which will certainly help you achieve any kind of goal of receiving some kind of income from your investment portfolio. The first thing to consider is compound interest, the reason being that over time, you would hope to see stable, steady growth within the stock price of the company in which you're invested into, and therefore the capital gains on the portfolio should hopefully grow over time too. Now that doesn't necessarily mean that the dividend income will increase in line with that, but what it does mean is that if you increase that value of that portfolio, you could use the capital gains on the portfolio to also pay you an income later on in life too. The second thing to consider is if you reinvest your dividends, you will obviously acquire more shares over time, and therefore the dividend payment will obviously therefore increase later on down the line. So essentially, the more shares you own, the more you can reinvest, and therefore the more dividends that you will be paid out at some point in the future. The third and the final thing to consider is the fact that some of these companies have literally increased their dividend for decades and decades and decades. So because of that, by the time that you probably want a bit of dividend income coming from your portfolio, actually you will need fewer and fewer shares because their dividend payments will increase over time. So you will be able to offset that slightly, and therefore the requirement for more shares in the portfolio will decrease slightly. So with that in mind, is it achievable? Well, from my perspective, it certainly is. Yes, you will have to play the long game, and yes, you will certainly have to rely on compound growth, and you will have to be very, very patient and invest regularly into the stock market over the course of probably a 20 or 30 year period. So that being said, guys, I hope you did enjoy that video. If you do want to grab a copy of this spreadsheet, I am going to upload it into my Patreon group, which you can sign up to in the link in the description. As well, if you do want one free share on Trading 212 valued up to £100, I will leave that link down in the description as well. So that being said, guys, be sure to smash a like on the video, subscribe to the channel if you're new around here, and with that being said, I will see you over in the next video.